Hey traders, I wanted to make a short video as part of a video series talking about some of the fundamentals of tradings and sort of going through some of the myths and dispelling some false ideas that people have, as well as opening other ones for potential debate. Today I just want to talk about time frames. I've been perusing the forums and noticed that a lot of people have sort of conflicting ideas about how to use time frames. As you mature as a trader, you're going to be able to get past having 6 or 7 charts, whereas you can see the same thing in just one chart. So just to, if you're like a new trader and you're trying to figure out how to set up your charts for instruments or a series of instruments, I'm not sure what everyone trades. It doesn't really matter whether you're trading forex, futures, or stocks. There are some considerations that you need to think about whenever you're setting up your charts for different time frames. One is the noise level of the instrument, and that is actually going to be varied depending upon what time of day for certain instruments, like the S&P 500 or the ES goes down sort of during after hours trading, but it peaks during the Asian European Opens. And that kind of makes sense. And there are some times, like I guess during lunchtime, Chicago time, which is essentially after the European markets close and everyone's going off at lunch at the CME. That's when it's going to get pretty choppy or, pretty noisy. And that just means kind of like back and forth, not much profit potential in that area. For instance, in Forex, a lot of brokers can have fairly large spreads for certain instruments. And so, if you're trading some obscure currency pair that has a 10-point spread, you can't try to be scalping on a 1 minute time, 1 minute time frame, unless of course the volatility is just suddenly through the roof. Usually those things are just going to have such low volatility that they're still profitable. You just have to go to a much larger time frame because 10 points is like essentially a tick that you have to make on the ES, where the ES spread is typically 1 tick, and you can get that tick in 5 seconds. Some obscure pair, you might have to wait a while before you get the same amount of money to pay for your commissions and or spread. Your trading strategy is also a very important fact that you need to consider. And that's basically whether you're doing larger trades, lower number of trades, but larger trades, or higher number of trades and smaller profits. And don't let people tell you that you can't do X, Y, and Z on instruments X, Y, and Z. You can pretty much, with some considerations, you can do whatever you want. It's just a relative situation. You can scalp the ES. You can daily scalp the ES. I do it all the time. You could definitely scalp the euro dollar. I'd probably say it's easier to do on the euro dollar, but you have to do it more, and it's kind of a give and take on that. But and obviously there are going to be some instruments that you can't scalp as easily and less. But this is all going to determine upon what time frames you want. If you're a scalper, you're going to be going lower time frames. Otherwise, you're probably going to be looking at daily charts to 4-hour charts. And volatility. Volatility is also a very dynamic thing. Particularly, probably go over this a lot in another video, but when there's profit to be made on smaller time frames, like I see people sometimes they have 4-hour charts and 1-hour charts, but especially like during the 2008 crash and the 2009 recovery, the prices were just moving so phenomenally, and people were missing thousands of dollars in profit because they're waiting for this 4-hour bar to close or something like that. And that's just ridiculous. At least I think it is. And maybe that's too much. That's too much heat in the game. I mean, really, it's just price move it over time. So whether you want something done fast or something done slow. Typically, though, the faster the volatility, the more you have to actually watch it while you're trading. So let me talk about the usefulness of with the considerations in mind. You got to think about what we actually use multiple time frames, and it's really just about visualization of the price. And if you had probably a big enough monitor, you wouldn't even have to do like multiple screens. You could have just one really big chart, maybe have really good zoom in and zoom out features, but I tell you, most charting packages are just not good for, at least not what I would ever want for trading. I hope someday make my own charting package, but whatever. At the moment, I use TOS to chart, and I use my broker's platform to trade. So, show you what I mean here. As you can see on the left side, I have a larger time frame. This is just the ES. I also trade the Eurodollar. I did not take any of these trades, so this is just today's front of the gun here. So here I have outlined sort of like the major trends, and I just kind of define a trend as it starts making lower lows, breaking trend line, strong move, lower lows, or higher highs, or whatever. And you could probably make a whole video on how you define a trend, and all the different ways aren't necessarily wrong. But as you can see, there's sort of this overall arcing broad downward trend that you start to realize once you get to down here. And within that, you are statistically going to have better success if you trade with the trend. And so here on the right side, I got the lower time frame, and I just drew a trend line, and I'm just showing you that if you take this trend here, if you take this point here, as opposed to this point right here, like so this is an upwards trend. If you try to buy here on like the third touch, you're not going to have as much luck as if you sell here on the third touch of this. And there'll be several times where you will luck out, but other times you won't. And so statistically, you're going to be better off going with the trend. Now trends do change, and that's just something that's more about I'll go into later about identifying trends. Another thing that you can see is that as you get better at looking at trends and looking at charts, you can actually reduce the amount of monitors that you have. So here or amount of charts and monitors that you have. Here I just have 2 showing the ES, but in reality, if you look here, I have these 3 points to match these 3 points. And you can just see that in the actual, you can just trade off these larger time frames if you want, just looking at the smaller trends within the larger trends. But for some people, it helps to see this, and particularly that goes to price action. And price action is the biggest advantage of using multiple time frames, because a lot of times candles hide price action. Now I'm sure you're all aware of like all the different formation of candles. And for maybe some instruments, like all these, there's like a page of like 500, no, not 500, like 50 different candle formations. And at that point, you're like, okay, so every candle means reversal. And obviously that doesn't give you much sense. In general, what you're looking at price action is price going in a direction and either stalling or reversing with strong action to the other direction. And if we take a look here at the end of the ES, let's use the ES because it's pretty for these demonstration. So I mapped out like that we're going down, and then when we get to about here, I say that we're going up. Whatever. And so these are potential buy points on the ES. Quite profitable, it looks like. So if we take these 2 last bars here, one thing that we can see is that, so if we imagine that we're in the price, it goes down, comes up, it closes, opens up here, and it may go up here, eventually it does come down here and then keeps going up here. But what you can actually see on a smaller time frame is you can actually see that price action. So right here is the close and open of these 2 last candles. So when this candle closed, it closed right here and opened up right here, and then went back down. And that's how you get these 2 tails. And so you can start seeing more price. Now this is kind of a lower time frame, but again, just like you can zoom in, or if you see enough charts on larger time frames, you can sort of infer the price action. If you see smaller time frames, you can definitely infer the larger price action. You just have to zoom out the chart, right? So it's not as algorithmic If you're trading live, if you're running algorithm, sure, it will matter. And I just have actually a 1600 right above it to show you um, the beautiful doji work. This is Hakanashi, but the beautiful doji's work to let you know. Oh yeah, by the way, this is a really nice reversal. So anyway, this was just a basic to sort of dispel some of the things. A lot of people tell you that, oh, if you're doing day trading, they say select this chart and this chart. But keep in mind that as volatility changes, you know, if you just stick to like a 4-hour chart and 1-hour chart, you're gonna miss what the price action is doing, and you may want to have a smaller chart up just so that you can actually see the price action. That's one of the reasons why I love tick charts, because they do show the flow of price that can get hidden during high volatility uh, market times, and that's typically when you can make the most money. So anyway, if you have any questions or if you have counterpoints to anything that I said, feel free to leave it in the comments below.